Well, thanks so much for tuning in to this earnings conversation with the management of IDFC First, Mr. Vaidyanathan Johnson. The Q2 FY23 was as per expectations, led by a 25% growth in funded assets and good asset quality. GNPA is at 3.18%, if I'm not wrong, and net NPA is a shade above 1%. He joins in to talk not just about the quarter, but also about the quarters ahead could look like for the bank and for the industry. Mr. Vaidyanathan, good having you. Thanks for joining in. At the outset, a happy Diwali and a prosperous new Samvat.
To all your viewers and to you and Vishnath and all of the program, very happy Diwali.
Yep, thank you so much. Let's kickstart with how you thought. I mean, both me and Vishy would just chip in according to what we want to ask you. But some of the quarter for us, because for many, it's a quarter of strong asset growth and benign asset quality, but one where the cost to income ratio stays elevated with a roadmap, I presume, of it going lower. So some of the quarter for us.
Well, I think you summed it up really very well. Let me leave it at that. Let me just say that the loan book, frankly, at 25% shouldn't surprise, because as you know, we've been guiding people for loan growth between 20 to 25%, and it's playing out exactly as per plan. As you know, we did not grow the loan book for 3 years at a stretch. That was some discipline, Neeraj, you'll agree, because we wanted to address the liability side issues. That's also done. So now we can look forward to growth in the next many years now, because now we have a strong foundation of CASA and all that. So profits are looking good. So I mean, we are feeling internally quite confident and strong now.
That's interesting. One follow-up in terms of so most people believe the asset quality issues for the industry at large will not be very high. There are not too many stress sectors left to really majorly trouble. And for most banks, lending practices are now evolved to such an extent that it's very difficult to get these going. So the question that I would have is, would you reckon that this benign asset quality that now we've been seeing at your bank for a while, that continues or stays on the improvement curve? Or could there be possibilities of accidents as credit growth picks up over the course of the next few quarters?
You know, in the credit industry, you should always be very careful. So we should start with that. Should always be. But since specifically for our organization, I must say that for like 11 or 12 years now, you remember we started the story in 2010. For quarter after quarter, 40 quarters at a stretch, if a gross NPA never crossed 2%, never NPA, let me say around 2%, and net NPA was around 1%. So I think it's a really long period to establish a model. Even after COVID, which is the only time it went up, now it's back to 2 and 1. In fact, a gross NPA is 2.1 now in retail, and net NPA is 0.7%. So we feel that if something is so well established, I don't see any accidents along the way. It's a long-term model. And I have actually a feeling, not just for our bank, I think that the Indian credit capability to evaluate credit has dramatically improved over the last 4 or 5 years because of Credit Bureau.
Vishwanath?
Mr. Vaidyanathan, the question I had was on the NIM part of the story. Now, of course, you're close to 6% now as of Q2. I mean, it's obviously one of the highest NIMs in the industry. How sustainable is this 6%? Is it largely coming because of the constitution of your portfolio right now? And secondly, now that you have some of the other lenders coming in, trying to expand their liabilities portfolio as well, credit growth is obviously far ahead of deposit growth. So people will start to raise their deposit rates as well. I'm just curious to understand what that competition does to the NIM part of the portfolio.
Actually, if you notice net interest margin, I agree with you. And if you notice, actually for most banks in the system has been quite healthy of late. The way I look at it actually that we've of course had a high net interest margin in our entire lifetime. Over the last 10, 15 years, if you take Capital First time and the bank all put together. Now, if you ask me to look ahead on this front, my sense is, of course, that I think banks are tight on liabilities, and I think banks are beginning to raise deposits. If you see some state banks also now talking of 7.5% for 60s. I saw one of the state-owned banks giving a rate for that for fixed deposit. So you can see that the rates are kind of inching up. But on the lending side also there is play. So broadly, I'd say that things will be stable.
Okay. Just to follow up to that question as well, I wanted to understand in terms of how can the industry manage the situation where you have deposit rates which are deposit growth which is far lagging the credit growth, because obviously at the end of it all you have to have some strong deposit growth which matches that credit growth, because otherwise future growth becomes a problem. How long do you think this lack of transmission will last?
See, definitely, I think rates will inch up even from here on the deposit side. And when a banking system slightly raises interest rates, money from the parallel system, let me say from the liquid mutual funds, etc., they come to flow back into banking. So I agree with you that the banking system deposit rate has to deposits balance has to rise to keep pace with this kind of credit demand that's coming up. But the solution to that, like I said, other sectors, money will move here with the slightly higher interest rates.
And just as an addendum, so CASA growth you've seen across the board, across many banks, looking very strong. Are people now depending less on fixed deposits, on term deposits as a product to save their money?
It's true to a point, but actually, off late, even fixed deposit rates have become very attractive. And we find that it's very sensitive because you raise fixed deposit rates by 25 basis points, money moves in, senior citizens move the money in, and so on. We have a thought of a change, addition proposition of late, which we haven't yet implemented, but we are planning to. Like, for example, apart from senior citizens, we are thinking of certain other categories for whom we might want to extend the benefit of higher interest rates, maybe like people who are handicapped, or people who are sports person, or people who are in the army and the services, and so on. And we're figuring out those categories. So we are actually thinking of giving certain extra benefits to customers. But broadly, we feel very confident. You see our last year's deposit numbers up 37%. We don't see a problem at all.
Back to you.
Okay. The belief, Mr. Vaidyanathan, is that the bank is entering a phase of strong loan growth, and as the drag from wholesale book moderates as well, which will be aided by a strong growth in profitability due to the replacement of high cost borrowings, better cost trends, and controlled credit costs. Which of these statements you don't agree with?
No, I feel that people have more expectations from our bank now, and I think it's a responsibility to live up to those expectations. The good news is that the underlying parameters, all the three items you talked about, every parameter is doing well. Net interest margin is strong, to answer your question. Number two, in terms of credit quality, my own estimate is that credit quality will actually improve from here. And we talked about the bureau factor. But also because of the fact that I think almost all banks have almost dealt with all the wholesale, challenges, wholesale issues. The phase in India, people have dealt with that. On the retail side, I think everybody has have learned with the times and the cycles. So I think bureau is a very big thing. These days, you can evaluate identity much better because it's digital. These days, you can evaluate cash flow in the bank statement much better because it's digital. So, of course, bureau. So the fundamental parameters that go inside creating good quality, they have come for India as a whole. I'm feeling better for India as a whole.
Okay. So, yeah. So where is it that you reckon demand is coming from the maximum? And where is it over the next 2 years, let's say, is where you believe demand will come in? Because there is much talk about the upcoming capex cycle. It's been there for the last 12 months. Somehow, while it's happening in bits and pieces and at the headline level and the PLI scheme level, it's not quite out there if I hear corporate commentary. So where is it that the demand is coming from? Is it coming from growth sectors? Is it coming from sustenance sectors, or is it coming from stress sectors wanting to get a lifeline of sorts?
No, I don't think it's a stress sector giving a lifeline. Talk to any banker, sit inside the corner room, they'll probably tell you they're all become very cautious, which is actually a good thing. If you ask me where's the growth coming from, of course, corporate sector will begin to come up again because India has to grow and all that. But I'll tell you one key element that will come as growth. On the retail side, India's credit market is about 45 lakh crores. India's GDP, as you know, is about 265 lakh crores. If you divide 44 lakh crores divided by 260, that's like about 17-18%. This number of 17-18% is a structural thing. You and me don't have debate. It's a structural thing. That number will head to about 25-ish% by FY 2030. And by the time, mind you, GDP will not be 3 trillion. It will be about 6.7 trillion. So on a larger GDP, which is about 7 trillion, you'll have 25% retail credit. So that's about $1.5 trillion. Today, it's $600 billion. So you can see $600 billion becoming 1.5, 1.4 trillion. So this is a mega play going on. I don't think it's about this quarter, next quarter.
Okay, so just one quick follow-up there. So therefore, the question before I give it to Vishy, you in the last 3 years, your retail deposits, I believe, have grown about 5x, right? And CASA has improved to 50%. Where do these numbers do you think can go from where they are right now for you?
We feel that, as you know, we have been very, very, very conservative at running this bank. We first build deposits, then we start build loans, right? We showed the discipline for 3 years. Now, this CASA at 50%, we believe we can sustain for a long, long time. We are very determined. We don't want to drop a guard on this front. So, as we'll bring the loan book, we'll keep growing CASA. And we are very happy and proud that we have 50%. We won't drop guard.
No, but just the follow-up there, Vishy, sorry, that 50%, if your retail deposits have grown 5x over 3 years, the bases are high. I know you spoke about the large numbers over the course of the next 7, but still trying to understand, do you envisage another 5x growth over the next 3 years in retail deposits?
No, you don't need 5x. See, that time when the bank started, we did not have any CASA, like we had some 5,000-6,000 crores, and loan book was 1 lakh crores. So that was a huge imbalance. So that's why you have to multiply 5x. Now we don't need 5x. As long as the balance sheet grows by 20-25 and deposits grow by 25-30, now we can sustain CASA at 50%. So at 25-30% deposit growth for a bank is, I don't need doubling. Just 25-30% is enough.
Got it.
Let me just add to this balance sheet growth question. Now, obviously, there is an element of provisioning that comes in as you see a growth cycle, because obviously the mistakes are made in the best of the times. But the question here is, do you foresee any additional, because you would be carrying on some of the provisions from the COVID period. Do you see anything additional that you need to set aside because of this 25%?
No. That's is a very good question, Vishy. The key thing to note is always pre-NPA. Okay, that is a lead indicator that's flowing into the NPA bucket. So which, as you know, since both of you are in the financial markets, you know, it's called the SMA.
Yeah.
So SMA is basically the pool between 61 to 90 and 31 to 60 days past due. So that bucket for our bank is now only 1%. It's a big deal. So if there's no money, if there's no portfolio, not much portfolio in that, I'm meaning for the retail book. So when there's not much there, I suppose there's not much will flow in NPA. So we don't expect much as a provision. On wholesale, you have to take my word that almost all bad loans are provided for, so we don't see any major problem there. No problem wholesale, no problem retail. We're going to have a problem.
So of course, I'll take your word for it, because overall that's where the trend is across the banking industry. So no reason to suspect here. But coming to the retail part of the portfolio, obviously there is a lot of competition, and it's not like, okay, everybody says that the pie is large enough that there's room for everybody to grow. But at the end of it, the people who legitimately deserve bank credit is still a very small portion of this large pie. I'm just curious to understand, how do you see the addressable market here in India?
No, pardon me, but I can't entirely agree that that the addressable market is already addressed. You know, this story, our next generation is coming up. They're all getting to the first jobs. You see the number of jobs being created in the IT sector, in this sector, and the new age sectors, etc. Like 450 million people in the country are employed. If you look at our bank, we may not have more than maybe 2 or 3 million of those customers whom you have to lend to. So this is a very generally, I mean, you walk the streets and talk to some 10 shopkeepers. I bet you'll not find more than 1 out of the 10 people who have borrowed a loan from a bank. The rest all are running 100% on equity, on their equity, family equity, and so on. So this is a truly underserved story. So I think that is the fundamental driver of this economy because India is massively moving from unorganized sector to organized sector. And unorganized financial market to organized financial markets, unorganized trade to organized trade, unorganized. So that's a very big game.
You're also one of the first few lenders to get on to ONDC. You're one of the first few lenders to get on the account aggregator framework as well. I'm just curious to understand how that translates to future business growth, because data. Yes, everybody says it in a slightly more vague format that the data is there, so obviously it gives you more insight into the customer. But for you as a bank, how do you see this? How do you see these as gates?
No, I'll give you a specific example instead of being, like you said, people give vague answers. So let me be more specific to you. So, for example, let me say that even 3 years ago, let me a few years ago, you want to meet a customer, want to give a loan. What do? You say, give me a bank license, give me a passport, give me my identity. Do you do that anymore? You don't necessarily do that. You say, give me your Aadhaar, give me your this, etc. And you do a more authentic ID authentication, because otherwise you can always fudge something on the record and all that. Now, if you looked at income records, earlier you'd say, okay, give me your income statement. So income statement, someone can probably touch up some numbers here or there in the paper. But when you're taking a bank statement PDF and scanning it, you can't touch it up anymore because the records speak. So step by step, the identification process, the cash flow evaluation process on the bank statement, the underwriting processes, these data have become much more precise and are able to lend much better. So I hope that give you more precise understanding of why credit quality in the country, in my opinion, will get better, because you should be careful always, but will get better because you have dealing with more authentic data now.
Neeraj, if you want.
Yeah, just a couple of industry questions actually. Not much about IDFC first. Though I wonder if okay, let's talk about ONDC at the end maybe. It's just one larger question around where do you think, what kind of sectors are driving demand? I mean, there is a lot of talk of how defense, some bit of electronic manufacturing, some bit of export-oriented themes, though in the current set of schemes, they might be a bit dull. But these are the ones which are currently the drivers for the economic growth. Where do you think, you are the lead indicator, right? You are the first eye of the pool, Mr. Vaidyanathan. Where is it that the largest demand growth for credit is coming from?
The largest growth is coming from the retail and small and medium sector, because they were the most parched. They had never got any credit, and nobody could lend to them because there was not enough data. You go to a shopkeeper and tell him your income 5 years ago, you couldn't figure out anything how to lend to party only. So now suddenly information is available and the need is there. So biggest demand, if you see the credit bureau records that is coming out, go to CIBIL and go to Equifax and look at where the demand is coming from. And even large corporates, I saw one of the large banks posting a 48% rise in lending to small business banking. So small business bank is giving working capital to the small borrowers. So that's the biggest area for growth. Of course, in the end, all this demand will translate to a corporate sector also, because if you're somebody buying more cars, as India is, more two-wheelers, someone has to make those bikes, which means someone has to buy those steel, someone has to buy the cement. So in a reflected way, it will extend to corporate sector also.
But not as yet. Not as yet. Okay. That's part one. Part two, you may refrain from answering this, Mr. Vaidyanathan. I'm still tempted to ask you. There is a mention of a large corporate house, REIT, Reliance Industries, making a foray into financial services. Now that you're a bank, I'm just wanting to understand from your landscape or your perspective, how do you think this has an impact on the existing ecosystem? Because the existing ecosystem is well entrenched. It's been there for a while. Does a new entrant who is traditionally known to be aggressive, does the new entrant have the potential to disrupt the existing well-oiled financial services industry?
See, I have always noticed with my many years of work that actually when a new player enters the system, or when the market grows, it opens up the whole ecosystem. I'll give an example, lest this get lost in some generalities. When Credit Bureau came for the first time in 2005, 6, 7, etc., I remember everybody said, "Oh my," existing lenders said, "Oh my God, this is my data. I won't share it. Why should I share it, the whole system," and so on and so forth. But over a period of time, when new players came and the data got shared, the system only got better. It became bigger and bigger from there on. So if you go back to US and see through the 1900s to 2000s to what it is today. So whether new players come, whether technology players come, or small finance banks come, or more banks come, or more players come, honestly, it'll open up the market, because don't lose sight of the big story of the next maybe 20, 30, 50 years. We should not forget that story.
Okay. So that's good from my end. Rishi, any more questions?
Yeah, just last couple of questions from my end as well, sir. You talk about this idea of, as the market expands, more people come in, and therefore, but then this expansion also usually leads to consolidation or business failures, because the competition increases to a point where certain players just don't find it sustainable to last in the race. Do you foresee something like that in the Indian market?
No, it's too early to talk about consolidation in this country. Actually, you should talk about introducing more players. So you see, for example, now I'll give you an example. Suppose we said credit market will grow from 600 billion to 1.5 trillion in maybe 8 years. Approximately correct numbers. Okay. Now that extra $1 trillion can be brought by existing banks, maybe brought by new players, but honestly, just not to be, just be technically correct with you to bypass the question. I'm telling you, don't forget how big this story of this country is getting. Don't forget the story. Just on the closing note, let me just tell you, US, what is the GDP of US? $22 trillion. What's the size of consumer credit in the US? $19.6 trillion. That's 85%. So when you're 14 or 17 today, do you have any doubts it will inch towards the 25 in a lifetime?
Just to close it off, you are being compared to the next HDFC Bank now, considering the numbers that have come in. As a leader of a new and upcoming bank, what do you see for yourself in the next 5 or 6 years or 10 years? Do you want to be compared to an incumbent, or do you want to have a story of your own?
We want to have a story of our own, actually, because I think that our capabilities are fantastic. We've got a very good technology stack. We've got a very proven model. I mean, for 12 years, if an NPA doesn't cross 2%, I think it says something, a cross basis. So we've got a really good model. Now, therefore, when we look ahead, we find that, of course, the ecosystem is changing. It's becoming much more digital. Our ability to plug into all the new ecosystems is important. But I think for us to grow at 20-25%, at least I don't see a problem. And that can mean a lot when you compound it over a 7-8 years window.
All right, sir. Thank you so much. That's it from my end.
Yeah, no, that's it. Thank you so much, and to you and your team. Great Diwali and a great Samvat.